Okay, so let's take a look at exercise 11-3. Right, so we're given some information here. We're given a segmented contribution format income statement for the company's most recent year. So the total company, and then their Toronto office and their Vancouver office. Excuse me. So we are required, by how much would the company's operating income increase if Vancouver increased its sales by $75,000 per year? Assume no change in cost behavior patterns. So there's no change in cost behavior, which means fixed costs are going to stay the same. And what they mean by that, don't mean to move the whole sheet here. What they mean by that now is variable costs are going to increase the same as sales. So our contribution margin here is 40%. So the costs are going to behave the same. So as sales increase, the variable costs are going to increase by that same by 60%. By the same percentage, they're going to be 60% of sales, and our contribution margin is going to be 40% of sales. So all we need to do here is multiply the increase of $75,000 by 40% by our contribution margin, because our fixed expenses are going to stay at 90. Okay, anyway, I'll ignore that. So 75,000 times 40% is 30,000 is the increased contribution margin, and fixed costs are going to stay the same, so that means the entire 30,000 is going to go to operating income. Then part 2, refer to the original data. Assume that sales in Toronto increase by 50,000 next year and that sales in Vancouver remain unchanged. Assume no change in fixed costs. Prepare a new segmented income statement for the company. Okay, things stop popping up. Using the above format. Show both amounts and percentages. So all the percentages are, sales are always going to be 100%. Everything else is what percentage is that number of sales. So right now, for example, 45,000, it's 45,000 divided by 150,000, and you get 30%. Contribution margin, 105,000 divided by 150,000 of sales, 70%. Traceable fixed cost here, 78,000 divided by 150,000, which you get 52%. So everything is just as a percentage of sales. So it says nothing has changed with Vancouver, so we're going to switch over to the solution. Vancouver is going to stay exactly the same. Let's scroll on down. Vancouver just copied over exactly the same. Toronto, there was 150,000 in sales, but it's increased by 50,000, so now it's 200,000 in sales. As sales increase, your variable expenses are going to increase also. So we already had worked out before, if I flip back over, that variable expenses for Toronto were 30% of sales. So now we just take 30% of our new sales amount, which is 200,000, and we'll get 60,000 for variable expenses, because we assume if sales increase, variable expenses also increase. That gives us our new contribution margin of 140,000, which is 70% of sales, and that's actually going to stay the same. Traceable fixed expenses, it points out that there was no change, so that's going to stay the same at 78,000, which gives us a segment margin of 62,000. And again, over here for your company, it's just totaling these numbers across. The common fixed expenses here will have stayed the same because nothing happened with those. So, and the rest is just copied over, or just totaled over, sorry. Now, observe from the income statement you have prepared that the contribution margin ratio for Toronto has remained unchanged at 70%, but the segment margin ratio has changed. How do you explain the change? Well, that's easy. So the segment margin, which is down here, the new ratio is 31%, and it was 18%. Split back here. So The segment margin ratio, it rises and falls as sales rise and fall due to the presence of fixed costs. The fixed expenses are spread over a larger base as sales increase. So this number here, because our sales and our variable expenses increased, but our traceable fixed expenses stayed the same. Contribution margin is stable so long as there's no change in either variable expenses or selling price. So here we increased our sales, but we assume that as sales increase, our variable expenses increased, and we kept our variable expenses at 30% of sales, which means our contribution margin holds steady at 70%. Okay, that's it for that question.